Welcome to MarketTamer.com. It is June 30th, and in today's video we're going to address a really great question from one of our members, Bennett, who asks, why is it that in some of the bull put spread examples in our video on demand modules at MarketTamer.com that we look sometimes at ranges of $1.30 to $1.65, whereas in some of the live classes, Mark has spoken about smaller credits in the order of 40 cents to 50 cents. So to answer this question, let's actually look at an options chain. And what I'm going to do initially is consider two bull put spreads. The first one is a 91.86 bull put spread. So the 91 strike brings in 320 in short put credit. The 86 long put costs 169, and so the credit overall is somewhere in the order of $1.50 there. So let's just keep that to one side now and move to another bull put spread. So in this case, let's go down 10 points and let's look at an 81.76 bull put. So an 81 short put brings in 85 cents, a 76 long put would cost 44 cents. So we're bringing in about 40 cents there, just over that. Now, the question is, which of these bull put spreads is the better one, and why would you choose one over the other? Well, first off, there is no better trade necessarily. There are just simply trade-offs between risk and reward, costs and benefits of each of the positions. So if we go back to the first bull put spread I mentioned here, the 91.86 bull put spread, which is on this options chain courtesy of optionsexpress.com, what we're going to consider here is the fact that we don't have to be right too often in order to make money. For example, if I'm right 3 or 4 times in a row, I can make, let's say, $1.50 times 3 or times 4, so I can make about $4.50 or $6. And if I'm wrong once and it's a total wipeout, I lose the risk in the bull put spread, and the risk is defined as the difference in strikes minus the net credit. So that's $5 minus $1.50, which is $3.50. So overall, I can trade this position, 3-4 times, and if I'm wrong once, I'm still ahead overall. Whereas if I look to, let's go the other direction. If I look at this position here, which is the further out of the money bull put spread, I need to be right very, very frequently. For example, if I'm right 10 times in a row on this position and I take in about 40 cents 10 times, that's $4. If I'm wrong on that position one time and it's a total wipeout, I end up losing the difference in strikes minus the net credit, which is the risk in the trade, which in this case is $4.60. So I make $4 and lose $4.60, and bottom line, I lose overall. So that's telling me that I need to be right time after time after time after time. I need to be right maybe 11, 12 times in a row, and I need to do that and not be wrong, and then I need to ensure I've even greater accuracy to make money consistently 20, 30, 40, 50 times in a row. Now, the reason that's possible and probable as well, sometimes it might seem like, wow, 10 trades in a row is very tough to get right. But actually, one of the benefits of this trade is that these options are so far out of the money. In this case, the probability of the S&P, which is what we're looking at, the S&P dropping very substantially in 50 days for this to go into the money is low. And so that's what this bet is about. It's saying, you know what, more often than not, I'll be right and I'll make a lot of money. Excuse me, I won't make a lot of money. I'll make a little bit of money each and every time I make the trade. And the chances are very high that I will make that money each and every time. Whereas if I go to the longer, the higher credit trade, which is this one, the 91.86, I will take in a nice premium, but it's near the money. So the probability is this could go wrong more frequently than the other position. So really that's what you're trading off when you're entering these positions. And if you have any more questions, this is a really in-depth question that has been asked. So if you have any follow-ups, please don't hesitate to ask us in our forums section or in the classes, and we'll be delighted to follow up.